Okay, reason number 5 why your mortgage application may not be approved: assets versus liabilities. So this is a pretty interesting topic. So I'm just gonna go on this one with a few examples so you can see what are the solutions. The example number 1 is height to debt, high debt to income ratio. So basically, that's when, in this example, let's say the monthly income of the person is $6,000, and the liabilities are $3,000 a month: credit card payments and car loans and personal loans. So the debt to income ratio is 50%, which means that he has too much debt in order for a mortgage to get approved. In these cases, and this is an oversimplified scenario, when you submit an application through us, most likely we will show you the details on how how the bank is declining your loan and what we're doing in order to approve it. But in this case, what are the possible solutions for this? One of it is focusing paying down the debt. You can pay down the debt, but you can also refinance the debt to reduce the payment, because the lenders are not too concerned about the amount of debt as the cash flow. So if the debt is the same but you can get a lower payment, that will help run the numbers better to be able to get you the mortgage that you want. Another one is sometimes by asking questions we can increase income. How you can increase income? Maybe there's other sources of income that are not reported that will help with the income part, or adding a cosigner or a guarantor to this application. And of course, choose a different lender. If there's lenders that will do exceptions to their own guidelines, but we need to build up that exception. Not because you ask you're gonna get, but if you ask in the right way and you supply the documentation supporting what you're asking, you have a better chance of getting that exception. Is sometimes is not as much as what you do, but how you do it that determines the outcome. Okay, and the example number 2 is cosign liabilities on the credit report. So the reason for the decline is, for example, very typical, the person cosign of a loan. In this scenario, we have a loan payment or a car payment of $700 per month, personal liabilities of $1,800. So the total liabilities in this case, if you add those up, will be $2,500. Now, have in mind that on average, a $500 payment will equate to $100,000 in mortgage financing. So if you have a $700 a month payment, just rough math, that means that your approval can be reduced by, let's say, 125,000, maybe 150,000 less, just because you have that car payment. If you remove it, that means that your approval will go up immediately $100,000 to $150,000 more. So how we can overcome this? Sometimes you show a document that shows that the person is just a guarantor, and you can show somehow that the payments are not being made by the applicant. A lot of lenders will say no to this, but some lenders may say yes if there is the appropriate trail document, and if it makes sense, because the overall application, maybe there's some more liquidity assets, and you can make a case. Okay, that's one option. The second option is you can refinance that loan to get a lower payment to make the numbers work. But then you have to work through those numbers and through that application as well. And of course, in this second point, you can go back and help the person who's got that liability to see if now they can qualify on their own for that mortgage, or you can switch the cosigner to another family member. Let's say the brother who's applying, and the other brother is the owner of the car. The brother is helping them as a cosigner, but now the brother needs to get his own mortgage. Now we trade this cosigner with perhaps another sister. Okay, and because the sister is not in the mortgage application, then this person is relieved from this loan, and we can get the mortgage. We are only transferring the problem to the sister, but hopefully, we can work out another solution for the sister in the future, or we work with the original person so they can get the car loan on their own in the near future. And number three, it says here, negotiate with the lenders. Some lenders are very tough to negotiate. They actually don't negotiate. You just have to find a way to make this happen. But I've seen situations where, for example, the car is used by the business, but they were signed personally, and we're able to transfer that car loan to the business, which originally is the benefactor of that car. So anyways, things of that nature. So these are three possible solutions for this scenario. Example number three, unpaid collections of judgments. When there's outstanding collections, judgments, or liens, you already know that the borrower's credit it will show the lender that they're high risk. For example, you have an outstanding credit card collection of $2,000. This is a very simple problem, and a judgment for unpaid rate of $5,000. Okay, so if you have both, it's becoming problematic because the lender is seeing a habit of this person not paying their accounts on time. It will be better if they only has one of those two for $7,000 because it's only one problem. Here we have two problems. But possible solutions. Okay, just pay it off in full. If you have the $7,000, you pay it off. We explain to the lender there was maybe a one-off situation, or if there was something extraordinary, like maybe a divorce, maybe there was health issues, maybe there was something out of the control of the applicant, and what remedy he's doing so that doesn't happen again. That will go a long way to explaining the lender the situation. You can also settle the debts for less. That will damage also your credit report. So it may provide a temporary relief, a temporary solution, or you can seek alternative lenders, or maybe look at private mortgage options where you can use private money, pay this off, and then allow for the credit history to recover, and then you can go back and reapply for a loan. So they're all strategies and solutions for this problem, but of course every single situation is a little bit different. In summary, assets and liabilities. The more liabilities, of course, the harder it is. If you have a lot of assets, the assets that you want to show the bank the most are liquid assets. If you have $100,000 in an RRSP account, for a lender is better than if you have $100,000 worth of gold, because the gold is not liquid, the RSP is liquid. When you have liquid assets, lenders have the tendency of being more benevolent with exceptions because they know that you can use the cash to solve problems. If you have the example of the gold, liquidity, the gold may not be easily doable, so you may not be able to make a mortgage payment or do something with that gold upfront. So just to summarize 3 quick points. If you have any problem with assets or liabilities, or income or debt or credit report, or property, or not the exact amount, or you just want to see more options, there's in general at a very high level 3 solutions. They're immediate solutions, so just by switching to another lender you can solve the problem. So those are solutions that we can implement right away, and that can come with documentation, experience, and a different bank and their guidelines. Number 2, there are short-term solutions. Okay, so a lot of the time you can get your mortgage approval in place if you're willing to accept a slightly higher rate, maybe 1 or 2% higher, for let's say 6 months to 18 months. And then the solution to your problem may be putting this mortgage with relaxed guidelines at a higher rate with a lender that are going to accept the terms that we propose, but only for a year, let's say 1 year or year and a half. Then when that mortgage, we do a term for 1 year, let's say. When that mortgage is coming up for renewal, during that year we solve the problem on the income, on the debt payment, on the property, whatever it is. And then at the renewal of 1 year, you can switch to a regular lender, bank or credit union, or any lender that has lower rates. I've applied this second strategy tons of time, and it works like a charm because you can give the mortgage up front and they know that the higher interest rate is not for the long term but the short term. And then when we fix the problem or the issue that is causing that higher interest rate, we can go back at renewal at a lower interest rate. And number three, there are strategy type solutions. They all require time and effort. This may not be what you're looking for, but it's similar to a health problem. If you have a health problem, you need to reduce weight. It's not that you're gonna eat a veggie today and then tomorrow you have lost 20 pounds. You have to work with time and effort to reduce the weight. Similar on the financing part. Sometimes it's just budgeting, sometimes it's just reviewing your credit history and talking to Equifax that may take months to fix. Sometimes it may be working with the accountant to make sure that your financials reveal your true financial position. It may work, it may be way different solutions that we are used to dealing in our office on a regular basis. My name is Camilo Rodriguez. I am a very passionate mortgage broker. I love to help people build wealth with debt. I am a proud father of two kids. My two kids are at university right now. I've been married 25 years. I love my wife. I love my family. I'm a family guy. I love traveling. I love watching soccer games. I'm a fan of the Vancouver Whitecaps and the Real Madrid, the best time in the world, the best team in the world. I am licensed and I provide solutions through my office and with my underwriters, with my team in British Columbia, Alberta, and Ontario. All the best. Questions, feel free to reach out to us. One more thing, I'm super passionate about artificial intelligence as well. All the best.